Welcome to Accounting 202 Managerial Accounting at Kapiolani Community College. In this video, we'll look at Chapter 15 and 16, which talks about managerial accounting and the process of doing job cost accounting. First of all, let's just clarify what's different about this type of accounting from the accounting that we did previously. In the PowerPoints listed at the additional materials in Wiley Plus, you can see a recap of the differences between managerial and financial accounting. I think it's very, very clear. Additionally, if we look at how a manufacturing company differs from a merchandising company, we can easily see that a manufacturing company has more steps involved because they have to make the product instead of just buying it and then reselling it. So the manufacturing cost flows diagram referred to here looks like this in your note packet. First of all, we want to clarify the kinds of costs that you can expect in a manufacturing company. The first kind, and the easiest kind to deal with, the least complicated, is what are known as period costs. Period costs are not closely associated with making our product. So they may be costs that just not related to making the product, or the costs that seem to be related but they occur after the product's already been made. In either case, those are period costs. They go straight to our income statement as a regular expense. However, when it comes to product costs, those are costs that are closely associated with the manufacturing process, and they're broken down into two subcategories which have further breakdowns. First subcategory is direct product cost. The real test of a direct product cost, you can have a long drawn-out explanation, or this pretty quick and direct one is, can you tell how much of that cost there is on each unit you made? If you can do that consistently and reliably, then call it a direct cost. If you can't do that consistently and reliably, then don't call it a direct cost. And you'll see there's a big significance about whether it is or is not direct in a few minutes. So the kinds of direct costs, we have direct materials and direct labor. Direct materials, also known as raw materials used or direct materials used, can be abbreviated as DM. Those are the dollar amount of materials that are used in our finished product, and I'm assuming we can trace it to each unit produced. For example, how many windshields are in an automobile? 1. The cost is easy to track. It's a direct material. It's a subpart, really. Direct labor is all the employee labor that's used to make our finished product. That we can trace to each unit produced. So if we have a record of how much labor is required to install the windshield on a brand new car, and we have consistent averages that we can rely on and typical costs of wages for that worker, then we can say the typical direct labor cost for putting a windshield in a car. On the other hand, as opposed to direct costs, we have what are known as indirect costs. Indirect costs go by multiple different names, but the basic idea is that these are costs that cannot be reliably and consistently traced to each unit produced. So you have to do some kind of process of averaging them over all the units you worked on. What that is something called overhead application. Overhead application involves doing a computation that arrives at the dollar amount of overhead that we should count on our product based on the kind of thing that causes that overhead to change. So a recap here, we have three kinds of manufacturing costs: direct product cost, direct materials, direct labor, and manufacturing overhead, which is by its definition not direct. So again, a recap: period cost, anything that's not directly related to making the product. So examples: selling expenses, general administrative expenses. Product costs as opposed to period cost. Direct materials, direct labor, both direct costs, and manufacturing overhead, which could include materials that we cannot tell how much is on each unit we made, labor that we cannot tell how much is on each unit that we made, and other kinds of indirect costs such as rent of our factory and so forth. So manufacturing overhead then is all product cost other than direct material and direct labor. Now there's some other names for these costs depending on how you combine them into pairs and so forth. If we take direct materials and direct labor, those are sometimes referred to as prime costs because they're our primary cost. However, if we put together direct labor and manufacturing overhead, then those are what are known as conversion costs because they're the cost of converting our materials into a finished product. So notice direct labor is both a prime cost and a conversion cost. At any point in time, if you were to stop and make a balance sheet for your company and an income statement and a cost of goods manufactured schedule, you'd see that product costs are included in one of these following accounts. Either raw materials inventory, because we have materials that we haven't even started working with yet, or work in process, goods in progress, goods in process, goods work in process inventory. Those are the cost of all products being worked on. So that's now includes direct materials, direct labor, and manufacturing overhead. Finished goods inventory, that would be the cost of all units that have been completed, and cost of goods sold, that would be the cost of all the units that have actually been sold. So in cost accounting, one of our biggest things we want to do is come up with a unit cost. Why do we need it? Well, it can help us to price our product appropriately, control the costs. So how do you get it? Very simple. Take the total cost that you have for making the units that you made and then divide by the number of units manufactured. That gives you your unit cost. So how does it work in practice? Well, we make a cost of goods manufactured schedule, and once we have the total of cost of our goods manufactured, we can divide it by the number of units that we've manufactured, and it'll give a unit cost. So we're going to use this kind of logic over here. I had some amount somewhere, it's called something. I added more to it, and then I had a new subtotal of that same thing, but more up to date. If I look at the end of the period, however much of it I still have around or on hand or still working on is counted as my ending inventory of some kind or another, and then the remainder goes to the next step. So for example, if I'm doing a cost of goods manufactured schedule and I want to come up with a total cost of all units completed, I'll take total manufacturing costs, which are direct materials, direct labor, and manufacturing overhead, and instead of doing the manufacturing overhead in extreme detail like we do in the homework and in Wiley Plus, I'll just give you like one number for the manufacturing overhead. In fact, I'll give you a percentage and a related number, and you just multiply it to get the manufacturing overhead amount. So how do you do a cost of goods manufactured schedule? First, take beginning work in process inventory. That's the dollar amount of beginning work in process. Put it on the schedule right after you've done your company name, title, and date, and leave it sitting in the far right hand column for like a long time. Step out and get beginning raw materials inventory. Add all your purchases of raw material for the year, and that'll give you a subtotal called total raw materials available for use, or total direct materials available for use. Either one is acceptable. Subtract your ending raw materials inventory that you've not used as of the end of the period, and that will be your direct materials used, or direct materials cost. Add direct labor that you've captured on your employee time cards and kept track of, and add manufacturing overhead that I will show you how to compute, and you'll get total manufacturing costs. Now take beginning work in process inventory plus total manufacturing costs, and you get total cost of work in process. So that's the total pool of all costs for everything you worked on during this period, done or not. Now calculate the cost of ending work in process through two major ways of doing so, shown in this chapter and in chapter 17, and that's ending work in process. Total cost of work in process minus ending work in process is cost of goods manufactured. So that's how you prepare a cost of goods manufactured schedule, and your quiz on this chapter will cover cost of goods manufactured schedule. So how is that guy connected to the income statement? It's the same basic idea about had something, added something, got something left, and the remainder. Cost of goods manufactured is equivalent to purchasing merchandise for a merchandising company. It takes what inventory you used to have and it increases it. So if we take beginning finished goods inventory, which is all those units sitting around waiting to be sold at the beginning of this period, and we add the cost of goods manufactured, that we calculated up above, then we'll get cost of goods available for sale. Subtract out your ending finished goods inventory, and you'll get cost of goods sold, which appears on your income statement right after net sales. Now, how do you do the accounting for all this? Well, there's a substantial number of new journal entries that you need to use in order to show how manufacturing costs go. And there are possible variations within the first two columns of it, but we're going to look at a more condensed, simplified version. Here's a quick review of a perpetual inventory system. When we purchase merchandise, we debit raw materials inventory now and credit cash, for example, or accounts payable. If we sell our finished product, then we debit cash or accounts receivable, credit sales revenue, and we also debit cost of goods sold and credit finished goods inventory. So what's changed here? Purchasing, we purchase only raw materials inventory, not regular merchandise inventory. And what's changed in the sale? We remove the item from finished goods inventory because that's the one sitting there ready to be sold. We don't have such a thing as merchandise inventory anymore because we make our own. So why do we need a perpetual inventory system? We got to have up-to-date cost records. It's very tough to not have a perpetual system in a manufacturing company. There are some strange artifacts that can occur as a result of this. For example, we can be counting the cost of labor in making our product and sending it to a new account to show that cost before we've ever paid the employees. The general idea is anytime we need to transfer a cost from one account to its destination, we debit the new account, the destination account, and we credit the old account or the source account. So for example, if we were taking our labor costs and recording them as some of them as direct labor costs, we would debit work in process inventory for the direct labor costs and credit factory labor. So here's a quick example of a cost of goods manufactured schedule. You can see the shorty version that I showed you is now expanded to include work in process at the beginning of the period. It sits there for a long time. We generate direct materials. We grab our direct labor information. And in the case of the Wiley Plus problems that you do, you aggregate all the manufacturing overhead and get a total manufacturing overhead number here. The grand total or the subtotal of those three guys is known as total manufacturing costs. Total cost work in process takes beginning work in process plus that. And when we subtract the ending work in process inventory, we get cost of goods manufactured. Looking at the balance sheet to see again the distinction between a merchandising company and a manufacturing company. In a merchandising company, we just have inventory or a merchandise inventory. In a manufacturing company, however, we have finished goods that are ready for sale. We have work in process that's still being worked on, and we have raw materials that we haven't even started making into a product yet. So quite a big difference there in inventories. So where do we get the information in order to keep track of all of these costs? Well, they come from source documents. For example, the materials we use that we can trace to each unit we make, we would grab from a material requisition slip. And we would use that material requisition slip to keep track of each job we're working on, material costs. And the labor time tickets for the labor that we can track to a particular job, we would pull from our labor time tickets, compute times the worker's wages and other costs, and throw that into our job cost sheet for a particular job as direct labor. And using something called the predetermined overhead rate that we'll discuss in a few minutes, we'll add a certain amount of overhead to our job so that we have direct materials, direct labor, and manufacturing overhead. Accounts-wise, this shows you in general how costs flow from one to the next stage. Manufacturing costs are incurred, such as purchase of raw material, factory labor by our workers, both direct and indirect of these costs, and manufacturing overhead. We assign them or calculate how much to put into work in process inventory. And that work in process inventory amount then leaves work in process when the goods are finished and goes to our finished goods inventory. Sits there until we've actually sold the product. So take a look at the handout that you have in your notes. It shows the relationship between journal entries, accounts that are involved, and the financial statements that these accounts are connected with. As product costs are incurred, we make journal entries like these. Once we know which costs are direct and which costs are indirect, we may make a combined journal entry that adds manufacturing overhead, including all costs, both all indirect costs such as general factory overhead, depreciation of equipment, other costs paid in cash, and indirect materials coming from raw materials inventory, and indirect labor coming from our factory labor account. All those costs coming out of their source account or into their source account, and in the case of manufacturing overhead, it will leave the source account and go into work in process. Only this $16 amount here will leave raw materials inventory and go straight to work in process. The other $2 will go to manufacturing overhead, and only 22 of this factory labor will go straight to work in process as a direct cost. The other $4 will go into manufacturing overhead. So we'll have a larger pool of manufacturing overhead from recording our direct and indirect costs. Once we've accumulated all the costs inside of manufacturing overhead, we'll allocate them or apply them to work in process using something called a predetermined overhead rate. So you'll see entries to work in process for direct material, entry to work in process for direct labor, and entry to work in process for overhead applied. Those costs sit inside a work in process until the item is completed. The job is completed. Then the costs leave work in process and go to finished goods inventory using a journal entry like this. They sit in finished goods inventory until we actually sell the product. At that point, they hop from our balance sheet in one of our 3 inventory accounts over to the income statement as cost of goods sold, and you'll see the dollar amount of the products that you're selling popping up as cost of goods sold in your sales entry. I referred previously to manufacturing overhead. What is it? How do we apply it? And how do we do the calculations? First of all, overhead is erratic and not evenly incurred. If you were to count the actual amount of factory overhead in a particular month for every month, you would have wildly erratic costs of goods manufactured from month to month, and we don't want that. So we kind of smooth it out by trying to do a massive estimate at the beginning of the year as to how much manufacturing overhead we think we'll have for the year and how much we think we'll have in what's known as the activity base. As a practical matter, let's say our activity base is our direct labor dollars. So if we incur more direct labor costs, our manufacturing overhead will go up by a fairly predictable amount. If we have less direct labor cost, our manufacturing overhead will be less by a fairly predictable amount. Now what do we do with that? We take our guesstimated manufacturing overhead for a whole year, our guesstimated dollars of direct labor for a whole year, and this is occurring at the beginning of the year. We divide the estimated manufacturing overhead by the estimated direct labor, and we get a percentage that relates how much overhead there should be related to every dollar of direct labor. If you were to do it based on machine hours instead of direct labor dollars, then you would take the dollars of manufacturing overhead, but you'd divide it by a non-dollar amount, hours of machine time, and you'd get dollars per hour of machine time. That's different than a percent. Percent has to have a dollar number to multiply by in order to come up with another dollar number, whereas machine hours already has a dollar number, but it's per hour, so you need to track the hours in order to come up with how much overhead there should be. So you take the manufacturing overhead from the manufacturing overhead account and you send it to work in process using one of these rates, depending on what activity base you're using. Direct labor dollars, machine time, could be direct labor hours even if you wanted. Now what do you do at the end of the period? Because we're estimating how much we're going to have in manufacturing overhead, estimating how much we're going to have in, say, direct labor, and then what we actually have could be pretty different from that. Well, you might end up with more overhead applied to work in process than you should have, or you might end up with less overhead applied to work in process than you should have. But most of it will have probably already worked its way through our system to show up in cost of goods sold. If it's during the month or the year and we're not at the end of the period, then we can bury that under or over applied overhead inside of a unearned or prepaid account to just kind of tuck it away somewhere and not have it affect our income. So if it's under applied overhead, we'll have a remaining balance in the manufacturing overhead account on the debit side. So under applied overhead, I'd show as a prepaid expense or prepaid asset on my balance sheet. However, if we counted more overhead than we had really incurred, or we used or applied more overhead than we had really incurred, then we would have taken too much out of overhead, so it would have a negative balance on the credit side. If over applied overhead, then during the monthly periods while we're making monthly financial statements, we just tuck that inside of a liability account like unearned revenue, for example. However, at year end, we can't allow this situation to persist. We need to clear out the balance of manufacturing overhead and make it hit zero. So you do whatever's needed to manufacturing overhead to make it hit zero, and then the other side of the journal entry is cost of goods sold. So I've been implicitly talking about a job cost accounting system. What is job cost accounting system? It's a kind of an accounting system where we track our costs very carefully by jobs that we work on, and each job is kind of unique and identifiable, so it can have its own job cost sheet or job cost ledger where we track its direct materials, its direct labor, and its manufacturing overhead. So because each job is unique and identifiable, they're easy to tell one from another. You have a definite time where you began it, and you have a definite time where you ended it, and you've been tracking the costs specifically for that particular job. So it's easy to summarize, come up with the total cost of the job, divide by the number of units that you made, and get the cost per unit. Kinds of things that you can use a job cost for: anything unique. Homes, yachts, customized surfboards, customized motorcycles, anything repair jobs, for example, complex repair jobs. How do you do the computation? Well, you pull all of the records for the jobs that have been completed because they will have been marked as completed. You take the total job cost for all those. You take the total of each job cost, you divide it by the number of units you produced, and you get a unit cost. Then you can use that unit cost to do things like send it to finished goods inventory, or to calculate the cost of the units that are sitting there waiting to be sold. Now, so a recap here: things you should be able to do. Make journal entries incurring job costs, product costs, such as in this first column here. Tell what accounts are impacted and use them at the appropriate time. Apply those costs to work in process when they're direct or when they're indirect, such as manufacturing overhead. Make the journal entry for sending cost of finished goods to finished goods inventory and taking them out of work in process. And finally, make a journal entry for a sale of some of your product, counting both its selling price as well as its cost. Thanks for listening. Hope this helped.